Hello, I'm Dr. Sonal Babbar, an Associate Professor in the Department of Commerce, Mettray College, University of Delhi. In the previous video, we saw the computation of income from the house property, where the property is self-occupied. We saw specifically the two cases there. Now we are going to start with the third case, where a part of the house property is self-occupied throughout the previous year and the remaining part is let out. Through this video, we are going to learn the computation of income from house property, where the property is self-occupied throughout the previous year and the remaining part is let out. Case 3 specifically. If the house property consists of two or more independent residential units, one part is used for owned residence by the owner and the other part is let out, then computation of income will be as follows. Let us say there is a house property which has got ground floor and a first floor. The ground floor is self-occupied by the owner for self-residence and first floor is let out by the owner. So here the taxable provisions of a let out property will be applicable, and here the property taxable provisions applicable for self-occupied property will be applied. For example, Mr. Jatin, a resident individual, owns a house which has two independent units of equal area. So there are two units, Unit 1 and Unit 2. Both are of equal area, so 50% each in size. Unit 1 is let out for residential purposes and Unit 2 is utilized for the purpose of his own residence. Other particulars of the house are given below. Municipal valuation 1,20,000. This is for the full house. Since there are two units of equal size, municipal valuation will be divided into two, and for different units it will be taken accordingly. Fair rent is again given for the full house. Standard rent given for the full house. Municipal taxes 26,000 paid for both units. Interest on capital borrowed, renewal of the property 36,000. Since the capital has been borrowed for the purpose of renewal of the property, the maximum limit is 30,000 rupees in case of a self-occupied property, self-occupied unit. Repairs 4,000 rupees. Fire insurance premium 15,000 rupees for the whole house. Rent for Unit 1 per month 8,000 rupees. Vacancy period for Unit 1 is 1 month. Unrealized rent for Unit 1. Rule 4 condition satisfied. And the amount given is 3,000 rupees. Determine the income from house property for Mr. Jatin for the assessment year 21-22 on the assumption that Jatin does not opt for the new tax regime under section 1.5 back. So here we would do the computation in manner where Unit 1 and Unit 2 are written, and Unit 1 is a let out unit, Unit 2 is a self-occupied unit. Municipal valuation of 1,20,000 will be divided into two parts, so 60,000 for a let out portion and 60,000 for a self-occupied portion, since it said the units are of equal size. Fair rent 1,50,000 again divided into two equal parts, 75,000 for let out portion and 75,000 for the self-occupied portion. Standard rent, the total is 1,80,000. Half of it will go for let out property and let out unit, and half will go for the self-occupied unit. So we compute the income from house property for Unit 1 first. Municipal valuation 60,000 of fair rent. So we need to compute the expected rent. For that, we compare MV or FR, we take higher of the two. Compare this with SR and take lower of the two. So expected rent is 75,000 rupees. Then we compute actual rent, which is annual rent minus unrealized rent. Annual rent given is 8,000 rupees per month. So for 12 months, it becomes 96,000. And there is unrealized rent, Rule 4 condition satisfied. Therefore, this 3,000, which is unrealized rent for the relevant previous year, will be allowed as deduction. So 96,000 minus 3,000 will give us 93,000. So 75 or 93, whichever is more, taken. So 93,000 taken. And we subtract loss due to vacancy. Loss due to vacancy will be computed with the help of the information given here. It says vacancy period for unit 1 is 1 month. The rent for 1 month is 8,000. Therefore, 8,000 will be subtracted and GAV for unit 1, which is a let out unit, will be computed. 93,000 minus 8,000 will give us 85,000 as GAV. Municipal taxes paid by the owner will be subtracted. Here we have municipal taxes 26,000 rupees. This is for both units, let out and self-occupied. So for let out, 13,000 is the amount. So we subtract 13,000 here. We get NAV, which is 72,000 rupees. We provide for deductions, section 24, subsection A, standard deduction. Section 24, subsection B, interest on borrowed capital. This is at the rate 30% of NAV, which comes as 21,600, and interest on borrowed capital. Since the interest on capital borrowed is given for the renewal of the property and the amount given is 36,000, again we divide this into 2 and we get for let out portion and self-occupied portion. So 18,000 here and 18,000 for self-occupied. In case of a let out property, there is no maximum ceiling. Therefore, 18,000 full amount will be deductible. So we get income from unit 1, 32,400. From unit 2, the self-occupied unit, we need not consider the MVFR-SR to get the expected rent. In fact, we know that NAV for a self-occupied unit is nil. Therefore, GAV will be nil. Municipal taxes paid by the owner will be taken as nil. Standard deduction will be nil. And there is a ceiling on interest on borrowed capital. However, rupees 18,000 is within the ceiling of 30,000 rupees. Therefore, 18,000 is deductible. As a result, we have 18,000 negative as the income from unit 2. So, income from this single house property where 2 units are there, unit 1 is generating income, unit 2 is generating negative income. So, 32,400 minus 18,000 will give us the net income generated from the property. Coming to case 4, where the house property is self-occupied for a part of the year and let out for remaining part of the year. If the house is used in such a manner, then the benefit of self-occupying the property is not available to the assessee. In effect, the property income is computed as if the property is let out, thus taking into consideration the expected rent for the full year and the actual rent of the property for the let out portion of the year. So here we are saying that during a previous year, the property is let out for some portion and self-occupied for some portion. So the benefit of self-occupied will not be available to the assessee, and it will be considered to be a let out property. Ms. Asha owns a house property in Delhi. The house was self-occupied for 3 months and let out for the remaining part of the year. So it was let out for 9 months. Compute the annual value for the assessment year 21-22. The municipal value is 1,60,000, fair rent 2,40,000, standard rent is 2 lakh rupees, rent amount per month is 30,000. Municipal taxes paid by Asha during the previous year is 20,000 rupees. Assessment year 21-22. So, computation of annual value for the assessment year 21-22. The house is let out for 9 months and self-occupied for 3 months. The municipal value 1,60,000 as given in the question, fair rent 2,40,000, standard rent 2 lakh. So we take the expected rent, higher of the two, 2,40,000, lower of the two, 2 lakh. So 2 lakh becomes the expected rent. Rent amount per month is 30,000 rupees. So the house was let out for 9 months, therefore the actual rent will be taken as 30,000 into 9, which is 2,70,000. We are going to compare ER with AR, take the higher 2,70,000 and that becomes our GAV. From this, we are going to subtract the municipal taxes paid by the owner, which is 20,000 rupees, and we get net annual value, which is 2,50,000. Next, we come to the topic unrealized rent, which is realized subsequently, or arrears of rent received. If the assessee lets out the house property and is unable to realize the rent from the tenant, it is called unrealized rent, and for which he claims the deduction, provided conditions of Rule 4 are satisfied. Later on, if he recovers any portion of such rent which has already been treated by him as a deduction, such recovery of rent will be taken as income for the assessee of the previous year in which such rent is realized. It will be considered as the income under the head IFHP. It is not necessary that assessee should own that house property in the year of recovery of rent. But yes, a standard deduction of 30% of the unrealized rent realized subsequently would be given to the assessee. So, unrealized rent realized subsequently, for which the deduction was already claimed by the assessee in some earlier year. So now this has been realized subsequently. For example, the amount realized is 40,000 rupees. So a standard deduction at the rate 30% of the amount so received will be given. So 12,000 will be given as the deduction, and therefore remaining, that is 28,000, which is 70% of the amount so received, will become income from house property. And the same treatment will be applied if the arrears of rent have been received and the rent has been revised with retrospective effect. So amount so received minus standard deduction at the rate 30% of the amount so received, and the difference will give you income from house property. Thank you.